and welcome to the Powers Now Media Affordable Housing Series with the Golden State Finance Authority. My name is Carolyn Sunseri, Director of Marketing with Golden State Finance Authority, and today I am your host. It's a great time to talk about real estate and to explore your path to homeownership. With me today is Eric Frazier, Vice President and Mortgage Advisor of First Bank. He's here to help us understand the requirements and process of qualifying for a mortgage loan. He's also the President and CEO of the Powers Now Media. Thank you for switching roles with me today, Eric. I'm very excited about the format for today's show. Over the past few months, you and I have explored how the down payment and closing cost assistance programs from Golden State Finance Authority can address the challenges faced by home buyers in coming up with down payment and closing costs associated with a mortgage loan. Studies keep showing us over and over that the largest burden or the largest challenge is down payment. And that's what new home buyers are faced with, especially minorities and millennials. So if you haven't watched part 2 and part 3 of this affordable housing series, I encourage you to do so. You can find those videos on our YouTube channel and website, www.gsfahome.org, as well as thepowerisnow.com. In those segments, Eric and I examined in detail the GSFA Platinum and Open Doors down payment assistance programs. And then in part 5 of the series, we interviewed an amazing couple who used the GSFA Platinum program to buy a home after having suffered some financial hardships and then finding themselves very discouraged by the home buying process. Their story should motivate anyone who is renting to at least try to get the help they need to buy a home. So here we are today on this final segment of our 5-part series, and we're going to tackle the mortgage qualification process in a very meticulous way for our viewers and listeners. As you know, Golden State Finance Authority does not place very many restrictions or guidelines on borrowers for them to be able to qualify for down payment and closing cost assistance through us. But we do rely and depend on our participating lenders to do the due diligence and ensure that the borrowers are ready and able to take on a mortgage. So let's get started.
Carolyn, a great way to determine whether or not a person can meet the guidelines of the Golden State Finance Authority is to talk about some of the challenges that many consumers are facing when trying to obtain a home loan. And these challenges are pretty significant in many cases, and it leads to discouragement. They don't want to move forward. They want to give up, and a lot of it is through reading things on the internet and trying to kind of figure out, if they qualify. And it's easy to get very discouraged. And we don't want anyone to do that. Do not self-diagnose. Don't try to do it on your own. There are people like Carolyn and I who will help you, and we want to guide you through the process. And so we're going to talk about several scenarios that represent these kinds of various life circumstances that people are dealing with, and they're renting, but they know they have to start renting. They got to get into a home, and they're looking to buy. And so hopefully they'll be able to relate to our scenarios and decide that, maybe I should move forward. Maybe I should at least talk to somebody and get the help and direction I need.
You're right, Eric. I mean, a story is what really brings home what is going on in someone's life. It gives us a chance to relate to them. Who doesn't like a great story? So let's get started with our first scenario. Now, this scenario deals with the GSFA requirements for debt to income ratios, and then ultimately we'll talk about how a cosigner and co-borrower can help someone qualify for a mortgage. So we're going to use the example, this scenario called drowning in credit card debt. Can I still buy a home? Now, the gentleman in this example is a 34-year-old father of 2. His name's Jason, and he came to his loan officer saying that he had started noticing that he had a major debt problem a couple of years ago when he was laid off from work. And at that time, he was living off of credit cards. He ended up developing over $30,000 worth of credit card debt. So despite the fact that he has a good job now, he's still using credit, a lot of credit, more than he should, and the balances are not going down. Now, apart from his credit card debt, he also has a student loan of $80,000, and the payment on that is currently in deferment. He's questioning whether he can buy a home with so much debt.
Well, a great question, Carolyn. And so first, I want Jason to know that he is not alone. Do you know that 45 million Americans owe $1.73 trillion with a T, trillion dollars in student loan debt? So he is not alone in dealing with student loan debt. And let me tell you right now, the student loan debt does not have to stop you. He's also not alone in just dealing with a lot of debt. Consumers, as in general, we utilize credit cards, and many out of necessity, some out of maybe not. They have been, just abusing their credit cards, and it was not intentional, but they just got caught up and started just spending a lot of money and running up credit card debt. And so the good news is that with student loan debt and even with credit card debt, you may still be able to buy a home. What we don't want you to do is self-diagnose your situation. Let a professional calculate what your debt to income ratio is. Figure out, if you can still swing it, with the student loan debt and the consumer debt. Because if you can, you need to, because home prices aren't going anywhere but up, and interest rates are going up now as well.
So I'm hearing you say, don't self-diagnose. It's important to talk to a mortgage professional, maybe even a HUD counselor if you'd agree, someone that can help you start looking at that credit that you're using, that debt that you have, and how to get it down, but also how is this affecting you? So let's deal with the actual issues in Jason's example. Debt to income ratio, or what is referred to as a DTI, and then the deferment of the student loan. Eric, I want you to explain to us what exactly is a debt to income ratio, how is it calculated, and then how is the deferred student loan treated in that DTI calculation?
Okay, so debt to income ratio is simply a mathematical equation. It's a percentage of your monthly expenses into your gross income. We literally divide what your monthly outgo is into your gross income, and that's before taxes. And that's how we calculate your debt to income ratio, which, by the way, folks, again, that's of your gross income, not of your net income, right? And so we're going to determine if you qualify for a loan based on your gross debt to income ratio. And I would highly recommend you figure out what your net debt to income ratio is, because just as the banks have guidelines around the maximum your debt to income ratio should be, you should have your own personal guideline as to what your max net debt to income ratio should be. And so to calculate the debt to income ratio, what we do is we'll take the house payment. And so you can easily figure that out, use a mortgage calculator for a home that you're going to buy in the neighborhood or market you're looking to live. And that payment, by the way, needs to include taxes and insurance and HOA dues and Mello-Roos. Any expense associated with that property is that payment. And then we're going to add to that your auto loan. We're going to add your student loan payments, and we'll get into that in more detail as to how we handle the student loan payment. We're going to add alimony, child support, credit card payments, just about everything that's on your credit report, and some things that may not be on your credit report, like tax debt. If you owe money to the IRS, you're making payments, and alimony or child support may or may not be on your credit report. And so we're going to take those total monthly obligations and we're going to divide that into your gross income. And that's how we're going to come up with a debt to income ratio. And then we're going to determine, based on that number, if you qualify. You may have to pay off some things. You may, maybe there's no solution because you don't have any money to pay off the debt, maybe you have to look at some alternatives to help you qualify because there's simply no money to pay off debt and you don't make enough money to bring to keep your debt ratio in line. Now, Carolyn, you mentioned a HUD counselor. I highly recommend that anyone watching or listening reach out to a HUD-approved counseling agency. They're everywhere. Just go to HUD.gov and type in the search bar HUD counseling agencies, and you will literally find them just about in every city or county throughout the United States. And these are professionals who are waiting to hear from you. If you have a lot of debt and you want help in maybe reducing the debt or lowering the payment or restructuring your debt so that you can put yourself in a position to buy now. So having a high debt to income ratio, it means that you cannot buy now. It does not mean that you cannot buy.
Okay, so how about student loans that are in deferment? How is that calculated as part of the DTI?
Well, great. I mentioned earlier $1.7 trillion in student loan debts. And so here's the good news, is that just because you have student loan debt does not mean you cannot qualify for a mortgage. For student loan debts that are in deferred, depending on the type of program, whether it be a Fannie Mae or Freddie Mac program, we're going to apply 1%, or it could be as little as 0.5% of the total amount you owe as your monthly payment. So for example, if you owe $80,000, 1% would be $800 a month. 0.5% would be what, $400 a month. So it depends on the agency, Freddie Mac versus Fannie Mae. It depends on the status of your student loan. Is it in deferment or is it in forbearance? Is the payment zero or is it not zero? Is it forgivable or is it not forgivable? There are so many factors that will determine how we use or how we would calculate, if you will, the payment to see if you qualify for a loan. You have to sit down with a mortgage professional. This is definitely not something you can self-diagnose, so that we can help you figure out how do we navigate through the student loan debt, because it can be done. You absolutely can buy a home with student loan debt. And folks, I know people with $500,000 and student loan debt, and they are buying homes. They happen to be doctors, but they're buying homes.
Thanks, Eric. That was really helpful. So your result is this DTI, which is in the form of a percentage. And of course, the lower that DTI, the less risk that you present to the lender who's lending you money for this mortgage or for this home purchase. But as you just mentioned, just because that DTI is high doesn't mean you are out of the home buying market. And we'll get into some solutions for a high DTI. But let's talk about the actual GSFA down payment assistance programs. The maximum DTI on GSFA's down payment assistance programs, with a few exceptions, is a 45% DTI. So what DTI should borrowers really have in order to be in the best financial position to buy a home when they're trying to access down payment assistance with one of GSFA's programs?
Carolyn, what a great question that is. And really, you're speaking to an area of, say, financial management or budgeting. And it's something that, whether you're buying a home or not, you should be concerned about your budget. Everyone should have a budget. There's no such thing as not having a budget. You just are not aware of it. You're just surprised at the end of each month, right, as to your financial situation. But we all have a budget, and it starts with writing it down. Now, before I get into the particulars of the answer that is to your question, I want to cover a couple of things I forgot to mention. Not everything goes into your debt to income ratio. Not everything, right? We don't count like your utilities. We don't count the cable. We don't count gym memberships. We don't count little Johnny's karate classes or Susie's ballet classes. So there's a lot of expenses that don't come into your debt to income ratio which is why it's so important that you have a budget. No one lives on their gross income. They live on their net income. So let's look at debt to income ratio. You're right. The 45 is the maximum debt to income ratio for the Golden State Platinum program, but the Platinum program will also allow you to go as high as 50 if your FICO score is 680 or higher. And so this really speaks to, managing your credit, right? And ensuring that you are doing everything you can to maintain the highest possible credit score, because there are rewards. The Golden State program at least will allow you to carry a higher debt ratio if you have a higher FICO score. The minimum score is 620, but with 680, your debt ratio can go from 45 to 50. So Carolyn, let me get to your question. What is a great debt to income ratio? Because I can go on and on and on here. Now, as I mentioned before, the debt to income ratio is calculating your monthly expenses divided into your gross income, but nobody lives on their gross income. We live on our net income. And so the guidelines say 45%. That's a guideline. Of course, it can be a little higher, 50 with great credit, but we're going to stick with 45%. Now, that's of your gross. A good debt to income ratio is actually less than that. It's actually less than that. Here's why. When you look at 45% and you compare what a typical person is going to spend in taxes, both for state and federal taxes and insurance, of that, it's at least 25% of expenses related to taxes that are going to be coming out of the person's paycheck. And so if your debt to income ratio is, say, 45, and you've got 25 to 30% in expenses, then that means your real debt to income ratio is 70 to 75%. So if a person is working with, say, $5,000 a month in income, that means after making the mortgage payment, they have between about 30% or $1,500 left over to buy food and groceries, to gas, transportation. It's a serious situation when you're looking at the debt to income ratios, and property values are just getting higher and higher. Interest rates are going higher and higher. And so that's really making it very difficult for people to afford to buy a home, even at the maximum required debt to income ratio of 45 to 50, if they can achieve that number.
That was very helpful, Eric, because now you're talking about real-time examples here of what kind of money we have available at the end of the day after we've paid that mortgage or that rent payment, our debts, our utilities, those types of expenses. And then at the end of the day, what you have left for groceries and your living expenses. So definitely encourage a budget. I think that is absolutely key if you are looking to buy a home.
Carolyn, the budget is so important because I have to tell you, as a mortgage professional, I am packaging loans and I'm advising people to determine if they qualify based on the bank's guidelines or Golden State's guidelines of a maximum debt to income ratio on the gross income. And so nobody lives on their gross, they only live on their net. It is so important that people understand that just because you qualify for a mortgage doesn't mean that you can actually afford that mortgage. And your budget will tell you whether you can afford it or not. The bank will tell you whether you qualify or not, but your budget will tell you if you can afford it or not. And I highly recommend using mint.com. Go to mint.com, it's free. Set up a budget, folks, and know really where you are. Don't just let me or any other mortgage professional tell you what you can afford. We can only tell you what you qualify for. You know what you can afford.
Eric, thank you for breaking down DTI in as much detail as you did. I think it's really helpful, talking about a budget. All of that is really helpful. Now tell us, really succinctly here, what would you consider a really good DTI if you were looking to buy a home, or if you're estimating where you are in that process of getting prepared to buy a home?
Yeah, a great question. So a great DTI, Carolyn, I would say it would be 35. And again, I'm not talking about your net debt to income ratio, I'm talking your gross debt to income ratio, what we use as a bank. I mean, we're talking all in total expenses, 35%, taken into consideration, that you have to live. And you want your housing payment to be no more than 30%, even as low as 25%. Now, I know this is difficult to achieve, but that means that if your front ratio and back ratio are almost very, very close, that means you have very little debt. And that's the ideal scenario, is to not have any consumer debt at all, and keep your debt to income ratio no more than 35% of your gross income. And of course, the more money you make, the higher debt ratio you can have. You have disposable income to work with. But when you're limited in your income, low to moderate income, you want to keep your debt ratio very low, 35 or less.
Okay, so an ideal debt to income ratio, 35%. For the purposes of the GSFA programs, we allow up to 45, maybe up to 50. Let's talk about those people in that high DTI, or maybe they're even higher and they don't meet the qualifications at all. What kind of solutions do we have? What are your thoughts about how to address somebody with a high DTI?
So first, Carolyn, a high DTI does not mean that you cannot buy a home. You absolutely can buy a home with a high debt to income ratio. Now, you may not qualify on your own, and we're going to talk about that because that's one of the solutions, is maybe not trying to do it on your own. But I would rather you, with a high DTI, paying rent, which is someone else's mortgage, buy a home with a high DTI and pay a mortgage on a home you own. It's just that simple. I mean, paying rent is literally paying someone else's mortgage. That's what it is. And I realize when you rent, you don't have all the other expenses that come with homeownership. But I tell you, I think that most people, when they really look at their budget, they can handle it. If you can pay a mortgage for as much as you're paying in rent, then you, without question, should be doing everything you possibly can with your high DTI and buy a house. It just doesn't make sense to pay someone else's mortgage.
This is part 5 of the Power is Now Media Affordable Housing Series with Golden State Finance Authority. We've been having a great conversation about debt to income ratio and how important it is if you're looking to buy a home. Next up, we're going to be talking about cosigners and co-borrowers as a possible solution if you have a high DTI. If you've been listening or watching, thank you. As you can see, we are diving deep into how to qualify to buy a home. There is a lot more to come. You are watching The Power is Now TV. We will be right back.
The Power is Now magazines are the leading resource for real estate agents, mortgage bankers, entrepreneurs, and small home ownership businesses, providing leaders with business strategy information, resources, and tools through PIN, real estate, programming guide magazines. Stay up to the minute with real estate news and information from industry experts. Subscription is free. Sign up today. thepowerisnow.com. thepowerisnow.com.
And we are back. Welcome to the Power is Now Media Affordable Housing Series. My name is Carolyn Sunseri, and with me today is Eric Frazier, MBA Vice President and Mortgage Advisor with First Bank, NMLS 461807, and President and CEO of the Power is Now Media. We have been talking about how to qualify for GSFA's down payment assistance programs to purchase a home, and we are using scenarios to explain the guidelines and offer solutions. Now, one of the things I mentioned before the break was that a solution to a high DTI may be to add a cosigner and co-borrower to your loan. And Eric, I want you to explain this, but does this also help with a credit score?
Well, it's a great question because there are many people who think that having a cosigner or a co-borrower could help them with their low credit scores or derogatory credit, and it's simply not the case. Cosigners and co-borrowers can only help you address the high DTI issue you may have. And you want to address that because, again, having a high debt to income ratio should not stop you from being able to buy a home if you have someone who's willing to help you qualify because they have the extra income you need and hopefully the lower debt, they don't carry much debt, to qualify for a home. So it's a great question, though.
Okay, thanks for clearing that up. So co-borrower or cosigner can help in terms of your debt to income ratio. Here's another question. If a borrower is getting help from a cosigner or a co-borrower who does not currently own a home, but they're now going to be a part of this new mortgage, is this going to prevent them in the future from buying their own home as a quote first-time home buyer when they're ready to do so?
Carolyn, I love this question. This is such a great question because I get it all the time. And there's a lot of misinformation out there about cosigners and co-borrowers. And I think that it's actually, hurting people because the short answer is no. The short answer is no. Absolutely, you can co-sign for your son or daughter, our best friend, or you two can come together, buy a home together, and co-sign for one another. And it will not stop you from being able to buy your own home later on, or even concurrently. Believe it or not, you can even do it concurrently and buying your own property while concurrently co-signing for someone else who is buying their own property. So absolutely, Carol, it's a great question. And I wish more families would come together and support each other in helping them to become a homeowner. And they're not doing this because there's this misinformation out there that it can't be done. If I help you, then I can't buy a house, and I need to take care of me first.
Okay, so this is making a lot of sense, but I always hear those terms cosigner and co-borrower, and I have a hard time with the difference, and maybe other people do too. So take us into how the cosigner or co-borrower is affecting the mortgage.
Okay, so let's talk about cosigners first. I want to talk about cosigners and co-borrowers, but I'm going to do them separately so that there's no confusion. So as it relates to cosigners, there are basically three important factors that I want to address. I want everyone to understand. Number one, all income and assets of the cosigner are being used to help you qualify if you're using a cosigner. That's number one. All income and all assets and all debt are being used to help you as the borrower qualify to buy a mortgage or to buy a home when using a cosigner. Number two, the cosigner is only guaranteeing the payment to the lender. They're guaranteeing the payment to the lender. They're not buying the house with you. They're not co-owners with you. They have no, say, fee simple interest in that property. They're not owners. They're simply co-signers. And that's very important because the cosigner may not even want to have that responsibility of owning a home, nor may you as a borrower want them to be, co-owners with you. This is your house, not theirs. You just need their help in qualifying for the mortgage. And then number three, the cosigners are able to obtain a loan on their own. They're able to buy another home on their own, even though they're co-signing for you. So those are the three major factors that I want everyone to understand. So let's talk about co-borrowers. Now, as I mentioned before, there are three considerations, three factors to consider when working with a cosigner, and a lot of those apply to co-borrowers, with the exception of these two additional factors. Number one, a co-borrower is also a co-owner. They're going to be on title with you on the property. So you definitely want to make sure that this is the right person you want to be in business with. If they're going to own the property as much as you are, and they have all the rights that you have to ownership of the property when they are a co-borrower. Number two, many lenders, particularly down payment assistance programs, will require that the co-borrower is going to occupy the property. If they're not going to occupy the property, then they may not, or you may not be eligible for down payment assistance with a lot of programs out there. Now, First Bank does FHA, VA, USDA loans, conventional loans, and co-borrowers are not a problem, most of the time on a standard loan based on agency guidelines. There may be some additional requirements, but for the most part, you're not penalized for having a co-borrower, except on down payment assistance. Now, with the Golden State Finance Authority for the FHA loan program, there's no issue with having a co-borrower. But for a conventional product, there may be a challenge if the co-borrower is not going to occupy the property.
Thank you, Eric. A cosigner or co-borrower is definitely one solution to help with DTI if you're looking to buy a home, but it does come with a whole set of challenges, and that's where meeting with your mortgage advisor and talking about your specific situation is so important. Now, our job today is to offer solutions and strategies so you can take advantage of the great opportunities that down payment assistance does provide. For those of you who may be just joining us, my name is Carolyn Sunseri, Marketing Director with the Golden State Finance Authority, and I'm here with Eric Frazier, MBA President of the Powers Now Media and Vice President and Mortgage Advisor with First Bank. This is part 5 of the Powers Now Media Affordable Housing Series with Golden State Finance Authority. Next up, we're going to talk about FICO score requirements and FICO scoring in general, so that you can know where you need to be in order to receive down payment assistance and purchase a home. If you've been listening or watching, thank you. And as you can see, we are diving deep into how to qualify to buy a home. There's a lot more to come. You're watching the Powers Now TV. We will be right back.